Welcome to About Money, a different approach to investing you won't hear anywhere else. Your hosts, the AFC team, Mike and Al, are registered investment advisors who have a proven track record of managing long-term investments surpassing the markets. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's your AFC team, Mike and Al.
And it is Saturday, and we're talking about money. We've got a lot to cover this week. So much to cover. We're going to start by talking about some of the predictions people have been making. You know, we're living in a time when things that have never happened before happen all the time. I used the comment that imagine in 2019, back in 2018, if someone would have approached you and said, next year there's going to be a new disease, something never seen before, and it's going to kill millions of people worldwide. Would you believe that? If someone in that same year would have said, in 2022, there's going to be a war that breaks out. It's going to be the largest war we've seen, and most of the world will choose sides, and those sides are going to furnish armaments to those people at war. Would you have believed that? Let me ask, does your financial plan for a pandemic or for a war? I mean, you're dependent upon that to get you the money you need for the remainder of your life. And yet, how do you plan for that? Not in most financial plans is that built in to have a pandemic or a war or whatever else might be coming along. We're going to talk about that. We're going to talk about some of the people that are making some short-term predictions and what they have to say. We're also going to talk, I just came back from the National Association of Pension Advisors Conference. That was last week. 1,700 or 1,900 people attending, 1,200 advisors, and a lot of support people talking about what's going on in the pension market, especially 401ks, because there's 60 million people that have no retirement plan other than Social Security. The government's concerned about that, and we're seeing something that was passed at the end of 2022 called Secure 2.0. The idea is to encourage companies to start a 401k plan. And we're going to talk about that. But first, let's begin with what people are predicting.
What are they predicting, Mike?
So, Bob Dahl.
Well, he was a senator. Wasn't he a senator?
He's the chief investment officer of Crossmark.
Wait, wasn't he the guy who ran for president against Bill Clinton? Oh, different Bob Dahl.
Different Bob Dahl. And it's Bob Dahl, I guess, D-O-L-L. And that was Bob Dahl. But Bob Dahl has been the chief investment strategist for a number of firms. Why he keeps changing, I don't know. Maybe it's because his forecasts are not working out, but maybe they are. But he is predicting at least a 17% drop in the market from where we are today.
He's saying we're going to breach the lows of October 12th.
Yep.
He says October 13th it dropped to 34.91. I don't recall that. That might have been a blip that happened. I thought it was 35.20 somewhere in that area.
I thought so too. I thought that was, and it may have been an intraday thing. And
yeah, I don't think it settled at that number.
No.
Yeah.
The lowest number that it ended the day at was on October the 12th.
Yeah, and he's just going off of that, because the Fed is tightening, and every time there's been a tightening cycle that we've had a recession.
That's been true.
But Mike, things that have happened before that have never happened happen all the time, right?
That's true.
And we're completely different than we were. Everybody wants to go back to the 70s, and we're a completely different economy than we were in the 70s. As far as a lot of the problem in the 70s was we were 30% union. I don't want to say a problem, but we're 30% union, and all those wages were tied to cost of living adjustments. When the consumer price index hit 11%, they had to raise all those wages. Less than 10% now are unionized.
Yep.
That's a sea change in the economy as far as how things are different.
That's one of the big differences. It's also a big difference in that we were really oil dependent in those days.
Yes.
The highest per capita oil consumption occurred in 1970 or 71. I can remember those times. I can remember having a car that got 6 miles to the gallon. Muscle cars.
Yep.
Those were big things. 6 miles, 8 miles to the gallon.
My dad had an old green Checker. Remember the old Checker cabs like you saw on the show Taxi? 8 miles to the gallon.
And that did a lot of city driving.
Oh, that thing was my friends used to call it the green bomber. It was like a tank.
But I can remember there were gas wars, and you could buy gas at times at 10 cents a gallon. I can remember in high school pulling up and saying, we'd like 25 cents worth of gasoline. Now, if you pull up to a gas station and say, I'd like $5 worth of gas, the guy will probably pass gas.
Yeah, probably. That's about all you're going to get.
And that's so, I mean, times were very different at then. Houses built without any insulation, single pane windows, no thermostat or setback thermostats. And the cars. I mean, I can remember I had a little sports car that I raced, a TR4A. And when the weekend rolled around, I would set the spark ahead to give a little more oomph to the car. Now, on an internal combustion engine, if I open and look inside, I don't know where anything is anymore.
No, you got to be you need to be an electrical engineer to figure out what's going on in them.
And Volkswagen, in their pursuit of doing an electric vehicle, they have 112 software vendors. 112. In the 1970s, there were no software vendors. You just had some wires that ran from the battery to the alternator to the spark plugs.
You have a thing, Mike, I don't think a lot of people would know, but that it had a thing called a carburetor.
Yeah.
Remember those things?
I remember that. I can remember dual carbs.
But I think the other difference today is that back then the consumers pulled way back. Right now, everything I see is the consumers are not pulling back, and they don't show any signs of pulling back. And we're seeing, like we saw last week with the manufacturing numbers come out. Oh, the manufacturing numbers are down. They're down here. They're down in Europe. They're down. People bought all they were going to buy during the pandemic. Of course, no one's going to be making. They don't need to be making stuff. What is it? Samsung said their profits are going to drop something like 90% because they're not making the chips. They need to make the not the high end chips, but just I think the memory chips.
Yeah.
Right. And then it goes through this cycle where they drop way off and then come way back up because people bought everything they're going to buy. But they're still spending money on services. 67% of the economy today is services.
It is.
People are still traveling. There's still Delta Airlines numbers. Their stock was down, but their numbers were up. And we're seeing this across the board.
The cruise lines, they have more bookings now than they had in 2019, and they have them at higher prices.
Yes.
I mean, it's when you think about it, during 2020, the government was passing out stimulus checks. At the same time, there was nothing to spend them on because we were living in shelter in place. So you couldn't go out to movies. There were no movie theaters that were open. Couldn't go out to sporting events. You know, it was all virtual.
But they're outspending it now, and I think even the talk of recession is not scaring people away. I think they're like, okay, if we go through a recession, we'll go through a little bit of downtime, but we'll be okay. And there's still, and the other thing, Mike, the labor market is just so dang tight, and it doesn't show any signs of slowing down. It's relentless.
It's getting worse.
How can we predict recession with the labor market that tight?
So there has to be close to 6 million jobs now, somewhere between 5.5 and 6 million jobs. More jobs than there are workers to fill them. And the situation is getting worse because there's only less than 100,000 new workers entering the workforce, and we're creating 200,000 jobs.
Yeah. I mean, I was looking at one stat on healthcare, nurses alone. They need a million. There was 1 million job openings around the country for nurses. And here in King County, they want to pass this measure to put all these open these clinics around the King County for 24-hour help centers for mental health and stuff like that, which could be a good idea. But how are they going to staff it is my question.
I was talking to a doctor the other day who said they have trouble staffing for surgeries. They're having to postpone surgeries because they don't have the staff to do it. And for a recession to happen, you have to reduce demand. You have to have companies that are showing lower sales. And we're seeing some areas where that's happening.
Yeah, one of the barometers they like to use is Fastenal. If you don't know who Fastenal is, they're a company. They make industrial bolts and products and all that stuff, and their numbers were down. Of course, if manufacturing is down, it makes sense that their numbers would not be down. So I don't look at that as a barometer right now for how things are going to go.
Yeah. No, it's in the service area. Overheard somebody saying the other day they had to pay $25 an hour to find a guy to wash dishes in a restaurant. I mean, we have a minimum wage of $15 and they have to pay $25 to find a dishwasher. But that's what's going on. And in order to have a recession, you have to have people slowing down their spending, businesses slowing down their revenues, a squeeze on profits, and you have to have banks reducing credit. And we're seeing some of that with Silicon Valley Bank. But still, the demand is there, the expansion is there, and people keep talking about the recession. I just don't see it happening. Even the Fed, which predicted minus 0.4% for GDP in the first quarter, it's going to be more like 1.5% or 2%. And it's probably going to be that way for this year and maybe into next year. So when somebody's predicting a drop below October 12th, got to raise the question, really? Really?
About money with your AFC team, Mike and Al, on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
So we've been talking about Bob Dahl, who's predicting that the market's going to be lower than it was in October. He's not the only one, by the way. There was just a new article out by Jeremy Grantham, who's predicting even a bigger fall. While Dahl is predicting down 17%, Grantham's predicting down 50%. And we've been hearing those kind of predictions for most of 12 months. People were predicting a recession in 2022. That's one of the big reasons why the market caved in. People were predicting a recession as early as the first half of 22. And then they thought the second half of 22.
And ironically, they're predicting get out of tech, right? Get out of tech. Yeah. What's led the
market up?
It's tech.
Tech.
Yes. If we go to the old FANGs, they're all up since the beginning of the year. Way up, and a lot of them since the bottom in October.
Yeah.
They've crushed the S&P 500.
So if you look at what's happened, we've been talking about a study that was done by Renshaw. Edward Renshaw out of the University of New York in Albany, and it's the late Edward Renshaw. But that study was published looking at times in which the market was down 5% or more and how it recovered. And he went back to the mid-1800s and looked at it from that period of time through 1990. And he found a consistent pattern that if the market was up, had recovered about a third of the drop from where it started, from the low, from where it started, the top to the bottom, if it recovered a third of that in 90 days, the market would generally go on to recover and go on to new highs. And we looked at that, and my first thought was it was in June. June didn't work out, but October, it certainly did. Because by June 12th, the market had recovered over 30%. For those, if that holds true, and it held true for Renshaw 42 times, and since Renshaw, it held true in 2000, it held true in 2008, and it held it true for 2020. That's 45 out of 45 times. That's 100% perfection. And yes, things that have never happened before happen all the time. It might not work out, but the chances are very, very good that it will work out. And if we look at where we are, we've been tracking that, and we've been positive for the market. We said you have to be in the market. The risk is being out of the market rather than in the market. And for our clients, we do a composite of our client accounts. Our clients were up 26.27% for the first quarter. And
Mike, let's clarify that. That's not back tested. That's not any of those data, finding those odd correlations or anything like that. That's actual client accounts.
And that includes all the clients in our growth accounts, every single one. This year, we've had 3 of our clients pass away. Those numbers are included in those returns. We've added more than 3 clients in the last quarter. All those numbers, no, in the first quarter they won't be. In the fourth quarter of last year, everyone who was in an account as of the fourth quarter of last year is included in those numbers. The people in the first quarter who came in the first quarter, their numbers will be included in the following quarter. And the ranges ranged from 14% at the low to over 40% for the quarter. The S&P 500 with dividends reinvested was 7.5%. But even that 7.5% was excellent compared to what most people are doing. That was a very nice number. That we were up 26%. That's pretty impressive. And we feel that we're going to continue that for most of the rest of the year. We feel it's the place to be is in the market, not out of the market. And the place in the market to be is with Adams Financial Concepts. And that's my own plug. But anyway. No. And for our clients, we're seeing much greater volatility. We had a up 77% year, up 40% year, down 50% year, but now we're seeing 25% up. I wouldn't be surprised. I can't say for sure that we will, but I wouldn't be surprised to see new highs within a relatively short period of time. There's a lot going on, and we haven't picked stocks that are well known. We haven't picked stocks that are wildly crazy either. There's a reason why the stocks are in our portfolios and they're performing very well.
Yeah, it's funny. Howard Marks talks about that in his last memo, Sea Change, when he was started out in the business in the 70s, late 60s and 70s.
Yeah.
And he talked about going into junk bonds when nobody wanted to go into junk bonds. And he realized the risk return, the return he could make by doing that when everybody was going the other way in inflation. And it's kind of interesting.
It is.
That you can, you don't listening to what all the commenters say isn't necessarily what's going to happen.
No, doing what most people do, was it Winston Churchill that said, doing what most people do is usually wrong? I think that was Winston Churchill that said it. He said a lot of funny things, but anyway, a lot of right on things.
Yeah, I mean, we talked about people trying to recognize patterns, right, and see what's going to happen. And it was an interesting study. It was a fake study done. I knew you get a kick out of it. It was this professor at Caltech, and his name was David J. Lenweber, Caltech, and he figured out how to predict stock market using just 3 variables, Mike. One was the butter production in the United States versus Bangladesh, sheep population in the United States versus Bangladesh, and cheese production in the United States. They had a 95% correlation and 99% correlation to the S&P 500 when it was back tested.
Man, that has to be plugged into financial plans right away. I mean, if you're doing asset allocation and doing coefficient of correlations, I mean, 99%.
99%.
You got to have your butter from Bangladesh.
Right. I remember you mentioning one about the prisoners from Alcatraz. And it was electricity consumption in the prisoners from Alcatraz.
My first professional job, graduated from Oregon State in the summer between graduating from Oregon State and going to Carnegie Mellon. I spent a summer working for Pacific Gas Electric in their operations research. And that was just early on in 1965 when people were beginning to apply operations research, computer analysis to data. And we plugged in everything we could think of. And it was linear correlation, so it's one variable versus another variable. It wasn't multivariate correlation. It wasn't canonical correlation. A lot of things you can do other than that. This is straight linear correlation. Variable A determines if variable A goes up, variable B has to go up. And the more A goes up, the more B goes up. Or vice versa, the more A goes up, the more the B goes down. Straightforward, very straightforward analysis. And we found that the best predictor of electrical consumption in Northern California was the number of prisoners on Alcatraz.
That's funny. It's almost like this one. So if people want to go look this up, I'll give you the name because you love the name of it. Stupid data mining tricks overfitting the S&P 500.
But you know what? We find a lot of things that have been done to backtest a model, to backtest and come up with correct predictions. Actually, I should say the predictions going forward are based on past data that shows how well things are doing. And I go back to my whole thing of who in 2019 would have predicted the pandemic. That's not built into any financial plans. I mean, but people will rely on back-tested data. Our data is not back-tested. It's just the actual results of our clients. They're net, after all cost, after all fees, after everything's taken out. And it is just simply an average of those accounts. It's not done on a dollar cost weighting. So anyway, let me shift gears for a minute, coming back to the conference that I was at. But even before I get to that, there was an article in Investment News. Did you read that?
No.
On target date funds.
I did read. Oh, yeah, that one. Yes.
Yeah.
What's their target?
The whole idea of a target date fund is to do a blend of stocks and bonds so that as you put that money away in your retirement plan, and there have been some that are predicting that 80% of 401ks will be invested in target date funds. The idea is it's supposed to do a glide path. Glide path is this new terminology to show the curve, how much you make now and how much you need to to have at the end of the time to replace 80% of your paycheck. That glide path is now set up so that target date funds will reach the right number of what you need to replace 80% of your paycheck when you retire.
One problem with that.
It didn't work.
Yeah.
It fell 14% short for people that are retiring in 2025.
And people getting sued over it.
Yep.
Because like when they ran correlation looking at that against the S&P 500 for cost and everything, and they realized, oh, wait a second, these are actually more expensive in two ways, because they were costing more initially and they didn't even beat the index.
They didn't even come close to being.
And they could have been in the index for like 10 basis points.
Yeah. So I mean, target date funds, and the concept sounds so wonderful. It sounds like a lot of other things Wall Street comes up with. You hire brilliant young guys who come up with all these brilliant young ideas, and they sound so good, but they're like chocolate-covered hand grenades. We're coming to a commercial break. Don't go away. We'll come back and talk about some more chocolate-covered hand grenades before we're done.
About Money continues. Remember the website, adamsfinancialconcepts.com. Here's your AFC team, Mike and Al.
So when we left off, we were talking about an article out of the Investment News that came out early this month about target date funds and people planning to retire in 2025 or 2024, even 2023, are suddenly finding that they're short of money. They're not short a little bit.
But just to clarify, Mike, in the target date fund, you gave a little bit of a esoteric explanation of it. So basically, what a target date fund is, it gets more conservative as you get closer to retirement.
Correct.
That's all it does. And so, and the question is does everybody need to be in that allocation when they get to 58, 59? Who the heck knows? I don't know till we sit down with you and talk with you and figure out where you want to be.
The important thing is to reach how much money you need at retirement. And we don't even think 80% is enough.
No, because
100% of your paycheck's not enough.
Because you don't know if people think Social Security is going to fill the gap. Who the heck knows what Social Security is going to be?
And medical costs are going to be a very significant portion of your living expense. And 50% of medical costs, a good portion, are in the last 6 months of life.
Yeah, long-term care cost. If you looked at long-term care insurance, look at what it costs. What's happened in the long-term care insurance market over the last 7 years, Mike, as far as cost. They've made it prohibitively expensive to get a long-term care policy, because a lot of, like the state of Washington came in with their plan to start a long-term care plan in the state of Washington. Well, it just basically crowded all the private plans and drove the cost through the roof. So,
talking about that, I had a cold call.
Yeah.
I get cold calls all the time. I love cold calls. I used to cold call. $29 a month for long-term care. I said, I'll take it. It only cost me $29 a month, and that's going to pay me $3,500 a month or whatever for long-term care. I said, I'll take it.
Take it, yeah.
I'll take
two. I give you one for Sunday.
Or try.
Yeah, buy all you can.
You know, the guy hung up on me. I don't understand why. Oh, well. But again, it's one of those things where, especially for seniors, there's a hook. And they try to hook you in at low cost. But when you actually get down to it, the cost is going to be much greater than $29 a month.
That brings it to another point about long-term care. Just to explain the cost, is that when they first started coming out with these policies about 40 years ago, the insurance companies who bank on something called the lapse ratio want the policies to lapse. And most insurances, the percentage they fix to lapse. Well, they thought the same thing would happen with long-term care, and they realized these people kept them. And they realized they sold the policies too cheap, and they started selling group policies. And people were getting group policies with no underwriting. And companies have just got caught with their pants down in their underwriters, and they had a cut off policy benefits. They had to raise premiums 30, 40, 50, sometimes 100%.
Well, and people were living longer.
Right. And so underwriting, they said underwriting went through the roof, and you couldn't even get a policy.
Yeah.
If you had if you had a hangnail, they said nope.
So anyway, coming back to target date funds is where we started. The idea is if you have a 401k, and most people are not investment experts, and most financial advisors don't understand what's going on in those accounts either. You know, it sounds so good. It's what I call a chocolate-covered hand grenade because it sounds so good. A mix of stocks and bonds that's adjusted every year so that when you retire, it's a perfect for your age. Unfortunately, not everybody is the same, so that's one of the problems that falls in. And the second problem we're seeing is for people retiring in 2023, 24, and 25, the target date funds on the average underperformed by 14%, but somewhere down as much as 19%.
Yeah, when you have a market like we've had the last year and a half, or 2 years, where bonds and stocks and bonds were correlated, where do you go for the safety?
And surprisingly, this is not one of those things that hadn't happened before. This happened in 2008.
Yeah, exactly.
Same kind of thing, except target date funds. The use of target date funds is something that's fairly new, and some of that grew out of 2008. No, target date funds were coming into their own in 2008, but a lot of people had to either work longer or cut back on the amount of expenses they could afford when they retired.
And now, so what's the new iteration into 401ks? They're putting annuities now into 401ks, right? Safety into 401ks.
Yeah.
And then Fidelity wanted to push to put cryptocurrency in 401ks, which doesn't make any sense. We're going to go from annuities to cryptocurrency with nothing in between and target date funds in between, and we can't put an individual stock or bond yet in a 401k.
Yeah, but we can now. We know how to do that
Yeah.
at Adams Financial Concepts. And
To explain that a little bit, Mike, because I don't think a lot of people have a good grasp of how that would work.
before I get to that, let me talk a little bit about the issue that's facing the country. 60 million people are not covered by 401ks, have no pension plan. They depend strictly on Social Security as their retirement vehicle. 52% of blacks have no retirement plan, 69% of Hispanics. So Secure 2.0 was passed at the end of last year to address that plan. It says that employers with 5 or more employees have to provide a pension plan. And there's a penalty if you don't do that. And to make it worthwhile, the government will give you tax credits up to $70,000. So, of course, a bigger firm is going to get a bigger tax credit. But essentially, you get to write off 100% of your cost for the first 3 years. So, I mean, it's extraordinary. And for us at Adams Financial Concepts, with what we do, we've seen a drop in turnover. But coming out of the conference, there was a report done by State Street, the Global Retirement Report, and they did a survey of several thousand people, and several 100,000 people, and 85% think that they will retire. 85% of the workforce thinks they'll retire. But 80% think that they will not even have enough money to retire when it's time to retire. 70% think that they'll retire after the age of 80. Think about that.
That must be you. You're still working.
I'm still working. My situation's a little different in that I do believe I will have enough money already to retire. So Secure 2.0 came out because most people, even who have a retirement plan, are not saving enough. And the number of people in plans is down to 50%. And if you take it a little bit further, it wasn't part of the report, but if you take people that are in SEP IRAs or Simples, a third of those people are taking their money out. They think of it as a bonus. Sure, they're paying a 10% tax. They don't care. That's extra money. They can buy a washing machine or a car or something with that. So a 401k changes the game. And part of this global retirement report said that since the Great Resignation, which is what people are now calling the Great Recession, since the Great Resignation, actually no, I've got that wrong. That is since COVID time.
Right after COVID, right?
43% of people want to work part-time. 46% want flexible job hours, and 16% want job sharing. But what was really interesting is that women on the average have $100,000 less in retirement than men. And so there's ways to catch up and secure point two. The RMD was increased to 73, and in 2033 will be 75, will be that. But the other incredible thing I found out of the entire survey was that 65% of the respondents wanted their employer to help and guide and advise for retirement. That's a dramatic change from what it was 10 years ago, when less than 10% of the people really wanted their employer to tell them what to do. Right now, 65% are seeking advice from their employer on what they should do and how they should structure it. And all that goes along with the fact that 68% of the people were worried about inflation. Inflation was not a worry 2 years ago. 0% of people were worried about inflation. Today, 68% understand there's an issue with inflation. So that was a lot of the conference, talking about that, talking about how to address that issue, talking about what we will do and how do you make it beneficial for a startup plan. If you're charging a small fee, like 1% of assets, how do you make that pay for itself when you have a startup plan where in the first few months, that doesn't even cover the ink to sign the contract? Actually, we don't use ink to sign contracts anymore. We do it with DocuSign, but anyway, the idea is how do you do it for small plans? And we have a thing that we set up at Adams Financial Concepts. We charge a minimum amount until the assets reach a certain level, and then it becomes a billing on the assets. And that's distributed for the employees to pay. So it's a benefit for everyone to do. And it's a benefit for employers. We're coming up to a commercial break, so don't go away. We're going to come back and talk more about 401ks and more about retirements, because it's a real topic. It's a topic your employees are talking about. It's a topic that the government's talking about. And if you're not thinking about it, you're missing what should be one of your priorities.
About Money with Mike Adams on AM 1300 The Answer. For more information, click on adamsfinancialconcepts.com. About Money with the AFC team, Mike and Al on AM 1300 The Answer. For more information, click on adamsfinancialconcepts.com.
One of the issues, we've been talking about 401ks, talking about target date funds, talking about 401ks. 60 million people in this country do not have a retirement plan. 60 million people. 52% of African Americans, 69% of Hispanics are not covered by a 401k or SEP-IRA or Simple. 62%. 60 million people. That was why they passed Secure 2.0, almost forcing any company with 5 or more employees to set up a 401k or a SARSEP or set by rule.
SARSEP, they can't set those up anymore, Mike.
That's true.
But talk about about our plans though, about how we can
one of the issues that has been raised is managed accounts within a 401k. How do you set them up? How do you charge for them? Because a managed account is more expensive than a mutual fund.
Yeah, but it gives someone the option to participate in our 26.79% of first quarter returns.
That's correct.
And so you're not going to get that in a 401k.
Not in most mutual funds.
No.
So the issue was, and we have 401ks that use our managed account. They did get a 26%. Actually, they got more than 26% in the first quarter. They were above the average. But when you really break it down into the difference of the cost, and no one at the conference was talking about that, they were all confused about what was going on. But if you have a mutual fund that has an expense ratio of 93 basis points or 0.93%, and you add on to that the charge, and in our case it would be 0.6% for a mutual fund, that's 1.5% already. When you add the trading into that, you add another 0.3%. When you add the custodian fee into that, and we just have an account at Nationwide that we're going to move as soon as we possibly can, that's another 0.4%.
Yeah, and then you talk. That doesn't even add on the soft dollar costs that are you can't find those fees.
The hidden fees.
The hidden fees, and you saw it from one of the companies we work with that they sent it to by accident.
Yes.
Yeah.
We ended up seeing some of the fees that are charged.
From 20 to 80 basis points per fund, the revenue sharing fees they were splitting.
0.2 to 0.8%.
That should be. I mean, that's paramount.
That's almost criminal.
It is. Yeah.
But even disregarding those, if you look at and break down the cost, the fees and expenses for a mutual fund versus the managed account.
And this is just what you can see. The fees, you're breaking down the fees, it's just the nominal fees that you can see, not the ones you can't see.
Our managed account is cheaper than the mutual fund accounts. Breaking it down.
But
I was really surprised.
Even cheaper though, because we don't, we're not into this thing of just this race to the bottom of trying to find the cheapest investment. They don't necessarily work. It doesn't necessarily work.
That's correct. That's the other point, is the returns on a lot of target date funds and other investments. There were, for a number of years, a number of lawsuits, class action lawsuits that were filed because fiduciaries in big companies were not selecting the least expensive mutual funds. They were being charged in this suit of not doing their duty as fiduciaries in finding the least expensive mutual funds. The employees were paying too much for fees. The newest thing that's happening is that there's class action suits that are coming out because the fiduciaries are finding low fees and low performance. So they're being sued because of poor performance.
Yeah, I mean, low fees is great, but if the performance isn't there, it doesn't really. Who cares?
Yeah. So the fact is, I know that Fundex did a study of all the mutual funds, 10,000 mutual funds, and found that there were like 240 mutual funds that had a return of equal to or better than the S&P 500. So that means only 2% of the funds are doing that. That means 98% of the funds are underperforming, and yet they're in every 401k.
Yeah, and the guy I mentioned earlier from Caltech, David Lendweber, him and his guys did another study about excessive trading fees and what trading fees actually cost, and excessive trading fees and how it really can eat into the returns.
It is. So we do managed accounts in our 401ks.
But our managed accounts, we don't do a lot of trading. We might do, a couple trades a year.
Yeah.
And so we're not in and out of these stocks. We're holding for a long period of time, which...
And our fees are all in,
Yeah.
net. So what a person sees on the return is actually after all fees and expenses. And comparing how we're doing with how the rest of the mutual funds are doing, we're outperforming. And we also do a lot of due diligence on our mutual funds. We're looking for a long-term track record of 10 years or more. We're looking for a management of that fund that's been in place for that entire 10-year time. And if the manager changes, we're going to delete that fund and find one other. We're looking for funds that have outperformed the Standard & Poor's 500 on the average by 1%.
And that have low turnover. I see some of the funds that I picked in a 401k, Mike. The guy'd been there a long time, but his turnover was 150-something%.
Yeah.
I couldn't believe it. I was like, some of them were, and there were funds like that. There were a lot of funds with the 80, 100%, 120% turnover.
Yeah. If you look at how Warren Buffett did, maybe the greatest investor of all our time, if you sat and watched the number of trades that he does, it's even slower than trying to watch paint dry. And we're not much. We're probably only slightly faster than Warren Buffett is. And, Bernard Baruch said, was it Bernard Baruch? I can't remember anymore. Said, no, it was Lefevre, the big trader. He said, it's not trading, it's not the action that makes the money, it's the sitting that makes the money.
It's patience, right?
It's patience.
You have patience, yeah.
It's patience that understands money moves in and money moves out of the market, money moves in and out of stocks, most of the time for little reason.
What does Warren Buffett say? It's the stock market's a place where the patient take money from the unpatient, or something like that.
That's correct. I mean, it's knowing. I mean, right now we're living in a time where money is moving out of stocks. I think Bank of America published the numbers and said that of the people in Merrill Lynch with stock holdings, $2.3 billion move out of stocks into bonds. I absolutely think that's wonderful, because there will come a day when $2.3 billion comes back into stocks. Mm-hmm. And it's the principle that for every happy buyer, there's a happy seller. Bernard Baruch did say, and Art Cashin paraphrased it by saying the stock market is a market of perception, that when people believe that 2 + 2 = 5, they'll pay 4 3/4 for it all day long. And my corollary is that when people believe that 2 + 2 = 3, what they bought at 4 3/4, they'll sell at 3 1/4 all day long.
And interesting enough, Mike, we mentioned all the people in the beginning talking about where the market's going to go down to 2,000, down 50%. But if we go by the fear gauge, the volatility index, it's only at 18.
Yeah.
It's at 17.8 right now. It hovers around 19 is its average. It's not telling me there's a lot of fear on the market.
Yep. And with that, we will wish you a very good weekend. And join us next Saturday, because next Saturday we will be talking about money.
You've been listening to About Money with registered investment advisors Mike Adams and Al Souza. If you'd like more information about what you've heard today, or about AFC's investment philosophy and strategy, or if you'd like the AFC team to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1300, The Answer. The preceding program was sponsored by Adams Financial Concepts.